Today's topic is something I wanted to get into with you as a CPA who knows a lot about this stuff, which is tax withholding, which is seemingly kind of snoozeworthy, but actually a little bit more complicated and a source of, I think, a good bit of financial strain on like the median American, right? Who doesn't necessarily understand the trade-offs, how it works, how they should be thinking about it. And then it ends up with a lot of people being in situations where they have to write a check at tax time that they wish they didn't have to write.
Yeah. I don't think it's bad to write a check at tax time. I just don't think it's bad. I just think,
economically, it's not bad. Psychologically, I think it's a big source of financial stress.
That is exactly what I want to get at. It's stress. It is not knowing. It was a surprise payment that I have to make at tax time that I might not be prepared for.
Exactly.
So,
a liquidity stressor that people, I've heard it a lot of times that people react very strongly and very emotionally to it. If they weren't, especially angry. If they just weren't prepared, right? If it comes as a total shock that you owe the IRS a bunch when you file taxes, that's a tough situation to be in.
Withholding usually is accompanied by an IRS form called a W-4. Usually when you start a new job, the idea is that you fill that out.
Is it your understanding that most people fill out an actual W-4, or are a lot of people just using some sort of payroll system that asks the questions that then transmit to a W-4?
Well, the payroll kind of knows how much you're getting paid. They kind of know because they're assuming this is the only job. And so as a result, they will adjust the withholding correctly. But there's limits, right? So in my experience, the standard withholding is 22% federal, I believe. So the withholding rate for supplemental wages is 22%. But sometimes if the payroll figures out that you're making more than $1 million, if that happens, then the payroll will increase it to 37% because at that point they know that you're at the highest bracket and they'll just withhold at that rate.
Zoom out even further here. Define what is withholding and why does it exist?
Yeah, so I think that's very important to understand. So in the U.S., if you're compensated via wages, there's literally 3 big taxes, I would say, or 4 big taxes. One is the federal income tax. Income tax everybody pays above a certain way. It's gradual, right? You have the 10, I don't forget, it's like 15, whatever the percentages are, and they increase over time. But then also for the first $140-something thousand right now, you have to pay Social Security taxes. And that's 6.2% on your side of things. And the employer needs to pay Social Security too for you, 6.2%. There's a max on that. So after the limit of Social Security, no more Social Security is being paid by both of you. Then you have to pay Medicare. And sometimes if you earn a lot of money, there's a Medicare surtax. And that's 1.45%, the regular one. And that's unlimited. Whatever you make as compensation, that's it. And remember, income is different from capital gains, right? So remember,
we're living in the wage world for this conversation, right? The world of earned wages from a company. It could be a company that you own, right? This can apply and very much does apply to the self-employed, but also to people who work for a company and earn a paycheck.
For wages, again, we have federal income tax. We have FICA taxes, which refer to both Social Security tax and the Medicare tax. And then you have also finally the state income tax, which, if you live in Texas and Florida or Washington or one of those special states, you don't have that. But most states, you have to pay state income tax. And in some cases, like New York City, you have to pay local city income tax. So those are like the big ones. And they all, typically, when you get your paycheck, you have those deductions. You have deductions for your federal income tax. You have deductions from your Social Security, Medicare, and state income tax. You might have some other stuff also there, but it's de minimis.
That's right. So this is like broadly a regime. And what is the purpose of this happening on every paycheck?
Well, back, I would say before this happened, the income tax was established and some other taxes were established. People came to the end of the year, they had to pay their income tax and they hadn't saved for it. And that's a big issue. And so at the end of the day, what this does, it's like a government mandate on companies to withhold, so you don't have to pay so much at the end of the year because most people behaviorally cannot save.
So it's both a behavioral thing of we think we wouldn't actually get all our income taxes. The IRS says we wouldn't get everything we're owed if we weren't getting paid along the way. It was probably also a liquidity thing at some point back when the IRS and the government actually needed liquidity from taxes. Everyone who has a job has to participate in this system, right? And it sounds like the base area where you can learn about this, see what's happening, is through payroll. So this is what we're talking about when anyone says payroll. Every company who pays anyone who has any employees has to run payroll, which is kind of a broad catch-all term that means pay your employees and do withholding and do it accurately, or as accurately as you can, right? And that's actually, like, we could say that in a simple 3-step instruction. It's not that straightforward, right? This is not a small obligation, and the complexities of payroll, in my opinion, shouldn't be understated.
I would recommend anybody who's looking at these things, or at payroll in general, and trying to understand their situation is just to download from their HR website their payroll statement.
That's kind of like I consider that source data, right? Like that comes straight from the source. That's where we know dollars and cents went. That gives us both current period and, for most pay stubs that I've ever seen, have year to date as well. So they'll tell you what you've paid into each individual piece of this year to date. There's a big thing that we're not going to get into today that you're going to see on pay stubs as well, which is employee benefits. Employee benefits, many of them flow through the payroll side of things. You're going to see those. If you don't know what benefits you're enrolled in, you may see some acronyms or some pieces on there that are completely confusing and don't make any sense to you, but they're probably related to I think everything on the pay stub is either a tax or an employee benefit.
So I just want to share with you an example of what a payroll would look like. I just Googled it. Number 1 is the employer. Number 2 is probably like some internal numbers here, and then the date of the payroll. This is not the date of the payroll. I don't know. This is probably the date of the document. Number 3 is the person who's getting that payroll. Number 4, employee ID. When the pay date began and ended. So this is important to know. Sometimes you're under the regime of twice a month, and sometimes it's bi-weekly. Bi-monthly. No, bi-monthly is twice a month. The other option is that it's every 2 weeks, right? So there's 52 weeks a year, 26 pay periods, but that's more than if you were paid twice a month, which would be 24. So know that also. Tax data is if you have any allowances. If you're married, then the tax status would say I'm married. If the allowances, I believe this has to do with how many children you have and how many. In the old system of W-4, which we'll talk about later, the allowances mattered a lot. Here you would have regular pay, and this is the pay. They tell you what your rate is and the amount of hours you do per week. That gives you to the earnings, and then you have the year-to-date column. And this is a year-to-date payroll statement. And then finally, you have the taxes. And so taxes here is what we're talking about. Federal withholding is the first one. Probably federal Medicare is the other one. And then WASD is, I forget what the acronym stands for. It's, I think, like Old Age Survivors Disability Insurance. And that is Social Security. And then the final one, in this case, it's Minnesota withholding, because this example is from someone who works at the University of Minnesota. And so then you have other deductions, which are before tax deductions. So these are things that will, in the long run, will be deducted from your gross earnings to reach to taxable income. So, medical insurance, dental insurance, the pre-tax deferral, and some, what do you call the stuff that you would get, like the perks? I forget the word.
Employee benefits?
Yeah.
Like commuter benefits, things like that.
Commuter benefits is one of them, yeah. They're specifically before tax deductions. And then there's after tax deductions, things that, the company will provide you with the option of buying, but it comes out of your paycheck.
It counts as
after
wages,
tax
right?
basis.
It's part of compensation.
Yeah. So child insurance, short-term disability, all this other stuff. And then there's employer paid benefits. So the employer typically he also pays a couple of things for you, and I believe that's part of compensation, right? So they pay a part of the medical insurance. They will pay part of the dental plan. They'll pay some basic insurance, life insurance. And
and each of these is confusingly, if you're going to go through each and every one of these, you're going to find areas that you're not going to know exactly what's going on with them, in my opinion, at least. For instance, in life insurance, companies are able to pay the premium, I believe, tax-free on the first $50,000 of benefits.
Yeah, there's a bunch of rules on that. I don't want to get into it now,
to peel back that I wouldn't encourage everyone to go all the way into. Just know that that's the function of the payroll system, right? Is to administer these things and get them right as right as they can with respect to taxes.
Yeah. So you would have total gross income for the period. Then what's taxable, right? Remember, you have before tax deductions. You would take off those deductions, $318, and you would likely get to $2,360 from $2,676 to $2,360, and that pays those taxes, right? So, and then it's taxed at, I believe it should be taxed at 22%, but I'm not 100% sure what the number comes up to. And then you have after tax deductions, and then the net pay. And the net pay is what gets deposited in your bank account. Kind of painful, right? That you went from 26 to 1766.
I've heard this so many times. Just
specifically when you're exiting college and you got your first job and you're receiving your first paycheck, and they told you would get paid I don't know, $60,000 a year, and so it's $5,000. If you're
a month,
a month. I don't know, 20, whatever it is, and then you see a quarter of half of it.
Right. Right. That is a tough one. Ditto as a server. If you ever served at a restaurant, and you have this, wad of cash that you earned, and then you get the paycheck of everything that came on credit cards, and you're like, oh gosh, this is so much worse.
I think it's very important to understand that if you see after 1 year that your total withholding does not cover your taxes by a little bit, then there's something, and it was a regular year, nothing special, you didn't earn extra income from some gig you made, then you ought to fix that, right? Because it probably means that you're under withholding. It doesn't have to mean it, but there's a strong chance that's the case. And so what do you do then?
The short answer is that you've got some homework to do where you need to make broad tax estimates. There are tools to help you do this crudely. There are tools to help you do this very, very precisely to kind of project what a total tax year is going to look like for you. But you need to do a tax estimate, and then you need to do a comparison of the rate at which you're withholding now and whether or not that's going to match up with this total tax estimate. Is that the broad kind of high level of how do I evaluate whether withholding is on pace?
Correct. Yeah, that's the way I would do it. I am very much in favor of essentially estimating your taxes every year. I think that's a very nice, for me, obviously, I'm a CPA and I have the tools. It takes me, it's quick. I can do it very quickly. I can understand. I have the tools. I can change the numbers and figure out what that means for my bottom line if I'm withholding correctly. And I just know what my end of the year tax bill is. I just figure out, project forward what the withholding will be for this year based on my income and my wife's income. And then what I do is there's a big difference, and I myself compensate that via estimated taxes. So every quarter I pay estimated taxes. Now there's another way you can do it, which is increase the withholding that you have. So every paycheck there's a little bit more taken out. You can do it either way.
For most people, so if we're talking about like if we're in the wage discussion, because yours is in the business owner discussion, which has a whole nother several layers of complexity.
Yeah. So I will say from a wage perspective, I think it's important that you change your withholdings. Who sometimes has, if you sell stock or if you have some other sort of income, if you like did a gig or something, at that point, it's like if that's a one-time income thing, then an estimated taxes is better, right? So one-time income, estimated taxes is better because it's not a permanent change. But if you have higher wages and the wages they're now withholding the correct amount, then you ought to fix that through a tax form that you have to give to HR, which is called, or the payroll department, which is called the W-4.
Is it fair to say that your payroll department or HR, let's say your company is big, right, and has a payroll or HR that you can contact, is it fair to say that they would be a good resource or decent place to start if you don't have tax software to make projections, or you're a little confused or lost in this? Is that a fair place to say, all right, maybe contact payroll and see where they might advise you to go?
Yeah, I don't know. I think that's a good step forward. Like, why not? You don't lose anything by doing that. My experience is that payroll will tell you, talk to your tax accountant. They'll tell you, we wash our hands in this because we're not supposed to give you advice. Talk to your tax accountant. And again, we wash our hands also in this show, and we say, talk to your tax accountant.
Yeah,
anything you speak here is not.
You have to. There's not really a substitute for the. There's not really a great substitute for the work. Like you can directionally use the type of rule of thumb that Gabe went over, which is that, okay, I had a normal year and then I owed a bunch of tax. You under-withheld, right? Like that part is clear, but how to change withholding and how to edit it in your particular payroll system, there's not really a substitute for going through and getting the details right or close to right there. But I think like the first step for anyone should be figuring out directionally, am I way off in one way or another, right? And some people, like you in particular, choose to be a little bit off on the paycheck withholding. Can you talk? So we kind of talked about the psychological side of it, but talk to me about the economic side of under withholding and then owing at the end of the tax reporting time.
Yeah. So, if you under withhold, that's very simple here. If you under withhold, there's a potential that you will have to pay underpayment penalties. And the IRS gives you three ways out of this. One is you withhold more, enough to pay the taxes. The other option is more of a formulaic safe harbor. It's saying IRS, you can, as long as you pay on a quarterly basis, equal amounts, like equal weight, up to 90% of your current year's tax liability. So if during the 2021, during the 4 estimated tax payment periods, if you pay 90% of your tax liability, you're off. You don't have to pay underpayment penalties. You will pay the 10% remaining on April 15th. The problem is, as usually, is most people have no idea what they're going to earn in 1 year, especially if you're a business owner. If you're a tax, if your only income is wages, then you kind of have an idea and you can actually do that way. The other way, which I think most people use, especially those who are business owners, they will use 110% of previous year tax liability. And this is if they are earning above a certain amount. And most of that limit is pretty low, at least for business owners. I think it's like 150,000 for joint income. If you're in the Northeast or if you're in California, that's not a lot of money. So we always use the 110%.
Under withholding, so absent the penalty, we know that you can get penalized, right, for under withholding. If you chronically under withhold, or if you under withhold way too much, you'll get a penalty. But let's say that you're out of that penalty range or you abate that in some way. There's people who differ on the philosophy of whether it's okay to under withhold, and it's my capital. I want to use it how I want it now, versus a lot of people say the phrase free loan to the IRS, right? If you over withhold, I'm giving capital to them early and I get it back later with no interest.
Oh, if you over withhold, they pay a measly interest on your excess withholding. And then with the excess withholding,
they pay
you can
measly? They actually do pay an interest, is what you're saying?
Yeah, it's tiny.
I've never heard of this.
Yeah, it's minuscule.
Mm-hmm. Okay.
They pay you an interest, and then at the end of the year, when you file your return, you get to decide what you want to do with that money. If you want to, put it towards the next year's tax return, or if you want to get it as a refund. Obviously, most people choose a refund, but there are some people who say, you know what? So people who make estimated tax payments will usually say, oh, you know what? I overpaid in my estimated taxes. That's okay. I'll use this amount of money for the first quarter's estimated taxes, which is the same day. It's April 15th. So April 15th is the first estimated tax period, and it's the final one. It's the final, that's when you have to file taxes in the previous year, right? So, and it's usually when you have to pay, when you file your the extension, or if you file your taxes in the first round, that's when you have to pay your taxes. So let me put it in specific dates here. 2020 finished a couple of months ago, right? We're in 2021. So 2020 finished. I figured out that I overpaid in my estimated taxes by, I don't know, $10,000. It's a miscalculation on my part. And so I filed my taxes March 1st because I was early. I got all my documents done. Like I was just super, organized this year. On March 1st, I can decide what to do with those $10,000. I can say I will apply it to first quarter payment April 15th. Right? So that means that I don't have to pay estimated taxes until June 15th. And then following one is September 15th, and the last fourth quarter estimated payments is January 15th. So that's kind of like the process that I go through. I think it's more important for most regular folks to understand how the W-4 works, and I just want to share with that. So this is the new one, right? The employee withholding certificate, right? So this is the stuff you would fill out and give to your employer, as it says here. Essentially, you have to fill out this part, the first step, which is your name, your last name, your social, address, city, town, and how you're filing, right? So if you're getting married in 2021, you will file, hopefully you will file married filing jointly. So in most cases, you would do this. Now, if you're earning a lot of money, it might be better off if you just click this, even though you're married. Because the single means usually that you're essentially it's a shortcut for withholding more money. Talk to your accountant about this. If you're always under withholding, a good way to change it without really going deeper is changing it from married to single. Even though you're married, you will be withholding slightly more dollars in some cases. Then step 2, this is essentially you have to go to this IRS W-4 app to get the most accurate withholding. So essentially you're filling out a tax return. Now, what kind of incomes do you have? How much money are you making? There's a worksheet. And if you have multiple jobs, then it gets a little bit more complicated because, the problem with multiple jobs is that, let's say in a regular year, you would earn $250,000. But if you split that in two, you would earn $125,000 in one job, $125,000 in the other job equally. Technically, if you only held one job, your Social Security tax, 6.2%, caps out at $140 something thousand. So after 140, and that's the real number. That's how you should be. But if you have two jobs, how will the one employer know that you already had like a previous employer that you pay Social Security? They don't know that. They will withhold the full amount, the full 6.2% for 125 in one job and 125 in the other job. And so essentially, you're over withheld there. So it's important to know that little tidbit there.
And on that, that may be confusing because so two jobs for one person, a harder scenario, and doesn't get captured very well by this form. But two jobs by two people who are married, they do a great job. They know how to do this. They can help you work through that scenario because two people who are married filing jointly are functionally one tax entity, right? It flows onto one tax return. And they know how to do that. Payroll systems have good setups for that. But you earning two wages from two different jobs, definitely not. Ditto with employee benefits, right? There's employee benefits that you can't duplicate between different jobs. You can only do it once. It just gets complicated if you're doing two jobs at once. Did I share with you this funny thing from Reddit where some guy said that he's doing like 10 remote jobs?
Oh yeah, it was the Wall Street Journal, like the guy who has multiple jobs, and there was Reddit, the outlier who does like so many more jobs.
That guy's withholding is going to be hilarious. And I do wonder if there's some mechanism by which one of the employers would figure that out through reporting, through like tax reporting. Anyway, that's a unique situation.
Yeah, I don't know. But step number 3 it's not necessary, but if you have children, you might want to claim your dependents. If you're under withholding, again, then I wouldn't fill it out because it would just reduce your withholding amount. Other income from other jobs that that hasn't withheld yet. And then in deductions, you go to a deductions worksheet on page 3. I think the instructions here have, they have pages here. So deductions worksheet, right? So you would fill this out and then report back this amount into the form. And then the most important part is the extra withholding. A very simple thing. Like if you ended up having to pay $4,000 in taxes last year, and you get paid once a month to make it simple. So that means that every month you should have withheld an extra $333, right? So 4,000 divided by 12.
But to make that more complicated, most people are not looking at this in December or January. Most people are looking at this in the middle of the year or after they file their taxes. Yeah, so and then you've got to compress that, right? If you're off last year, you think this next year is going to be similar, but you've only got now 8 months left in the year, right? We're not talking about, what'd you say, 433 or whatever it is. You got to divide that. You got to push that into a smaller number of months.
Let's see if married filing jointly. I mean, these tables, they're helpful. I personally don't use them, but they're helpful. I use the tax software, and I would highly recommend folks to just outsource this to your tax accountant if you have one.
Especially if you have high income, a complex situation, outside things, side business, significant capital gains. There's just not really a substitute for doing a real tax estimate. Yeah,
and that your tax preparer should be able to do this. And then once you finish the W-4, you just forward it to your HR department you figure out who the person is that handles this, and then you forward it to them.